In 2008, a bank in Mexico noticed that drug cartels were bringing in cash boxes too large to fit through their teller windows. So the bank widened the windows, not to stop it, to make it easier. That bank was a subsidiary of one of the largest financial institutions on Earth. Between 2006 and 2010, it processed at least $881 million in proceeds from the Sinaloa cartel and the Norte del Valle cartel, two of the most violent drug trafficking organizations in history. The cartels used the bank's own specially designed boxes to deliver the cash. The boxes were built to fit the windows. The windows were built to fit the boxes. This was not negligence. This was infrastructure, built on purpose, by people who knew exactly what it was for. This is the story of how a global bank got caught laundering money for the people responsible for tens of thousands of murders and walked away with a fine smaller than 2 weeks of profit. Welcome back to Guilty and Free. There is a phrase used inside the United States Department of Justice that you are not supposed to hear out loud. It is too big to jail. It exists because there are institutions in the global financial system so large, so interconnected, so central to the functioning of the economy, that prosecuting them criminally is considered too dangerous to attempt. Not too dangerous for the bank. Too dangerous for everyone else. This is the case that proves the phrase is real. Because the bank in this story did not commit an accounting error. It did not misclassify a transaction. It built physical infrastructure to accept cash from cartels responsible for mass murder. And when caught, prosecutors decided that charging it with a crime might break the global financial system. So they didn't. To understand the scale of what happened, you need to understand how drug cartels actually move cash. Cocaine sold on American streets generates enormous quantities of physical currency, small denomination bills, collected from thousands of individual transactions. That cash is bulky. It is heavy. It is difficult to move across borders without detection. The Sinaloa cartel and the Norte del Valle cartel needed a way to convert hundreds of millions of dollars in street cash into usable, internationally transferable funds. They needed a bank that would not ask questions. The bank's Mexican subsidiary became that bank. Cartel couriers brought cash in specially constructed boxes, sized to maximize the volume that could be deposited in a single transaction. Boxes large enough that they did not fit through the standard-sized teller windows used at the bank's branches. This created a problem for the cartels. So the bank solved it. Internal compliance staff later testified that they had flagged the unusual size of the cash deposits and the physical modifications made to accommodate them. The concerns were raised. The concerns were not acted upon. Between 2006 and 2010, The bank's Mexican operation transferred at least $881 million in cartel proceeds into the United States financial system. That figure is not an estimate from journalists. It comes from the bank's own admission in a 2012 legal settlement. This was not a secret that emerged only after the fact. Internal compliance officers at the bank had raised concerns about its anti-money laundering controls for years before the scandal became public. A 2010 internal memo, later obtained by U.S. Senate investigators, showed compliance staff describing the bank's Mexican operations as posing the highest money laundering risk of any of the bank's subsidiaries worldwide. The bank's own risk assessment, written by its own employees, identified Mexico as the single most dangerous jurisdiction in its global network for exactly this kind of abuse. The bank continued operating in Mexico without meaningfully strengthening its controls. A 2012 U.S. Senate Permanent Subcommittee on Investigations report, running to 335 pages, detailed years of failures. The bank had failed to monitor over $60 trillion in wire transfers for suspicious activity over a multi-year period. 60 trillion. Not because the technology did not exist to monitor transfers at that scale. Because the bank had not invested in the compliance staff and systems required to do it, despite knowing, by its own internal assessment, exactly where its greatest risk was. The Senate report found that the bank's compliance department was so understaffed and under-resourced that it could not process the backlog of suspicious activity reports it was legally required to investigate. The backlog, at one point, exceeded 17,000 unreviewed reports, each one a potential warning, each one unread. It is easy to discuss laundered money as an abstract figure. It is harder and more important to understand what that money was for. The Sinaloa cartel and the Norte del Valle cartel were not abstract criminal enterprises. During the years this bank was processing their proceeds, Mexico's drug war was producing death tolls in the tens of thousands annually. Cartel violence during this period included mass killings, the targeted assassination of journalists and officials, and the kind of brutality that journalists covering the conflict frequently described as exceeding the standards of organized crime seen anywhere else in the world. The money that moved through this bank's Mexican branches was not separate from that violence. It was the violence, converted into a form that could purchase weapons, pay corrupt officials, fund cartel operations, and launder the proceeds into legitimate businesses and real estate. Every dollar that the bank processed without asking questions was a dollar that had already been extracted through violence and was being made usable for more of it. The bank did not pull a trigger, but it built the financial infrastructure that let the triggers keep being pulled at scale. When U.S. federal investigators began examining the bank's conduct, the evidence was not ambiguous. Internal documents, the physical modifications to bank branches, the compliance staff testimony, and the sheer scale of the unmonitored transfers created what prosecutors internally described as one of the strongest money laundering cases the Department of Justice had ever assembled against a major financial institution. Prosecutors prepared to seek criminal charges. Then, something happened that is documented in subsequent congressional testimony and reporting. Senior Department of Justice officials, including the Attorney General, were briefed on the potential consequences of a criminal conviction. A criminal conviction of a bank of this size could trigger the loss of its banking license in the United States. The loss of its banking license could trigger a broader collapse of confidence in the bank. A collapse of confidence in a bank this large and this interconnected with the global financial system could, according to the briefing, pose a risk to financial stability comparable to the 2008 crisis. The Department of Justice made a decision. They would not file criminal charges against the bank. They would offer a deferred prosecution agreement instead. In December 2012, the bank agreed to pay $1.9 billion to resolve the investigation. It was, at the time, the largest penalty ever paid by a bank in a money laundering case. It sounds enormous. It is not relative to what it was measured against. The bank's pre-tax profit for that year alone was $20.6 billion. The fine represented approximately 9 days of the bank's annual profit. The bank signed a deferred prosecution agreement, not a guilty plea. The agreement explicitly stated that criminal charges would be filed only if the bank failed to meet specific compliance benchmarks over the following 5 years. It met them. The charges were never filed. No senior executive at the bank was personally charged with any crime. No banker lost their license to work in the financial industry. The then head of the bank's compliance division resigned. He was not prosecuted. He continued his career in financial services. During subsequent congressional hearings, a senior Department of Justice official was directly asked a question that became the defining moment of this case. If a small community bank in rural America had laundered this same amount of money for the same cartels, would it have been prosecuted criminally? The official did not give a direct answer. The implication, widely reported and never seriously disputed by the Department of Justice afterward, was clear. A smaller institution would have been prosecuted. It would have lost its banking license. Its executives would likely have faced individual criminal charges. It would not have employed thousands of people whose jobs the government did not want to risk. It would not have been interconnected enough with the global financial system to make prosecutors and regulators afraid of what a conviction might trigger. Size was not a mitigating factor in this case. Size was the defense. The bank's scale, the very thing that should have made its conduct more dangerous, became the reason it was treated more leniently. This case is often cited as the clearest example in modern financial history of a principle that regulators rarely say out loud, but consistently act on. When an institution becomes large enough, the calculation made by prosecutors is no longer simply, did they break the law? It becomes, what happens to the rest of us if we enforce the law against them? That calculation may be rational from the narrow perspective of preventing a financial crisis. It is also, by definition, a system in which the law applies differently, depending on how large the lawbreaker is. A bank too small to matter gets prosecuted. A bank too big to jail gets a deferred prosecution agreement, a fine measured in days of profit, and a press release that says compliance has been strengthened. The cartels whose money was laundered did not stop operating because of this case. The bank did not stop being one of the largest financial institutions in the world. And the phrase "too big to jail," once a dark joke inside the Department of Justice, became, after this case, simply an accurate description of how the law works. This is Guilty and Free. $881 million laundered. $1.9 billion fine. 0 criminal charges. 9 days of profit. They got away with it. Subscribe. New video every week. The next video asks the question this case makes unavoidable. If size is the defense, what happens to everyone too small to use it? They built bigger windows for the money. Nobody built bigger consequences to match.